Top-down is very important for fixed income credit products. I think individual investors tend to forget that. They might buy a listed product and just expect that the price of that product doesn't change. CBA did a Pearls issue about 2 years ago where soon after issue the price was trading at 85 cents in the dollar, and people were shocked by that. People need to understand that firstly, top-down is important as bottom-up within kind of constructing a fixed income portfolio. Fixed income has a broad range of different products. They behave differently, they trade differently. Investors need to understand all the risks that are involved in the products that they buy. One of the problems within the domestic market for those looking for fixed income assets is that it's suited for the institutional investor rather than the individual investor. The listed space, listed assets only comprise around 6 or 7% of the total credit assets domestically. What we do within the Alexander funds is we focus on specific parts of the credit market that we think are actually cheaper. We invest in private debt, we invest in RMBS, we invest in short-dated loans. A lot of this investors simply can't get access to. So very difficult for investors to try to replicate what we're doing in the market. SMSFs have a great allocation to equity and property, and they need to become more conservative, we think, in their portfolios and invest in fixed income product. The market is changing. There's NAB's doing a wonderful thing by originating small deals and placing that into their private client networks. I know that. So there's a lot going on, and it's all moving in the right direction, but we do have a long way to go. For that, in Europe, individual investors or retail investors have 50% allocation to fixed income. In North America, it's a lot less than that, but it's still a healthy 25%. So if we're talking about SMSFs moving from 1% to, 10% or 15%, that's a huge move. That's a great demand for fixed income product. There's a reason why SMSFs are so under-allocated, and that's because Australia hasn't had a recession for 25 years. We've got Australian equities have great dividend processes and policies. And so people haven't been shocked by their portfolios and needed to search for kind of more conservative assets. So I think, at some stage that will happen, that the SMSF sector will migrate more into more conservative asset classes and alternative asset classes, but more conservative asset classes like fixed income credit, because they see that there's too much risk in the property market and too much risk in the equity market. Ultimately, I think the migration into fixed income credit speeds up when people get hit by negative returns in property and negative returns in equity and start realising that they're taking on much more risk than they should for a kind of a balanced portfolio. There's more and more fixed income credit and fixed income interest rate portfolio managers coming into the market, and that's a wonderful thing. Certainly within the equity markets, I think that's a good idea, that individuals try to mimic portfolio managers. It's a little bit harder in the fixed income markets, even if they do have accessibility to the product. When you're talking about an RMBS product, a residential mortgage-backed security product, when you're talking about a credit-linked note, or you're talking about an asset-backed security, or you're talking about a Tier 1 structure, these, the legal framework around all these type of products are very complex. And so even if you have broader access to the access to the market, or broader access to the market, I think you're still going to have trouble with people knowing how to replicate a particular institutional manager's portfolio, and knowing what risks lie and knowing when to take the asset out.